So first of all, Mike, what you only see my head. You don't see my arms, my heart. You don't see all the scars that I have from those years. And I do have not physical scars, but financial scars, wallet scars, emotional scars. So I was in the middle of that storm with many properties, with a lot of my clients.
Hi, this is Garrett Sutton, and you're listening to the Average Joe Finances Podcast.
Welcome to the Average Joe Finances Podcast. Are you trying to get out of debt, invest, or just not sure where to start? Then this is the place for you. We discuss different ways to get out of the rat race and build your wealth. Join us on this wild ride to financial freedom.
Hey, welcome back to the Average Joe Finances Podcast. I'm your host, Mike Cavaggioni, and today's guest is Dani Beit-Or. So, Dani, I am super excited to have you on. We're going to be talking about some real estate today, and that always gets me pumped up. So, thank you for joining me today.
Oh, my pleasure. Thanks for having me. Such a great opportunity. Always. Thanks. Thank you very much.
Absolutely. The pleasure is mine because I get to ask you questions and pick your brain, and it's what I enjoy doing. Before we get started with that, I want to start this off the same way I start every podcast episode, and I want my audience to get to know you a little bit. So if you could share a little bit about yourself, tell us your story. Who is Dani Beit-Or?
That'll be terrific. Glad to do. Like you said, I'm Dani. I live currently in Southern California, married. I have one gorgeous little boy who's almost 11, love of my life. I was born in Israel. You may be able to hear some accent in the background.
Not at all.
Trying to get rid of. Not at all. Thank you. I am not
like
trying to get rid of it.
Like you've been in California your whole life.
That'll be a first. By the way, not trying to get rid of my undistinguished accent. So I was born in Israel. I grew up in Israel, just outside of Tel Aviv. I spent 2 years in Washington, D.C. for high school. But other than that, my whole upbringing was in, say, a middle-class family. My dad was military, career military, an officer in the military. And I spent 3 mandatory years in the Israeli Special Forces. So that was quite an experience. Let's just put it this way. And post my military service, I got my engineering degree. And while I was working for some veteran startup, not a new startup, but a startup, but it was already kind of a few years down the line, I just noticed that financially, I am not on the right path. I felt like I'm on the wrong path financially. I'm on the path that everybody's taking around me, probably without even trying to, or life is putting you on a path because you're just seeing what everybody else is doing and you're doing about the same. And very early on, I realized something is wrong, something is off, something doesn't add up to the way I perceive my life to be. And I knew that I have no problem. Even back then, I knew I'm a hard worker. I had no problem with working hard and working long and putting the time and effort and caring, even if it wasn't my own company. But I just told myself, Dani, you're going to work for other people and you're going to be doing okay. I didn't want back then, still don't want just to do okay. I wanted to have something to show for all the hard work that I know I'm going to put in the coming years. I didn't even think of decades, but the coming years, to show for all that long time, missing on life stuff, missing on social stuff, traveling because I'm working. And I just started looking for another avenue, another way to propel or excel financially. I didn't know how to do it. I just knew the default is not something I'm not excited and also not okay with.
Yeah, absolutely. As you were describing your background, I was taking some notes as you were going. So now I know you spent some time in D.C., right? You said you finished your last 2 years of high school in Washington, D.C. Is that because your father was something with the U.S. military and over here, or?
No, my dad was a military attaché from Israel to the U.S.
So you came over with him?
Exactly. So it's a family assignment for 2 years. For me, it was one of the best things that happened to me in life because when you get as a teenager to D.C., my English was poor at best, right? So my English was not very good. Hopefully it's gotten a little bit better since. So I had to really work on my English very quickly because that was a survival tool with the girls. So my English improved within 2 weeks. I had no choice. And I got my diploma, my US high school diploma. So that was also good. I got my social security number, also benefits. For many things, those 2 years gave me so many treasures for the future without even realizing at the time. And that, I don't want to say it set me on for life, but it gave me a better foundation for the future journey that back then I had no idea that's what's going to happen. So that was really amazing 2 years for me. And I had a good time. I had a blast for those 2 years. I was just enjoying my life as a young teenager, but still I was just having fun.
Yeah, no, that's fantastic.
Yeah.
After you finish up high school, you wind up going back to Israel and you served your mandatory time in the military for 3 years. When did you actually move back to the United States?
In 2004, I moved to the States. Beginning of 2004, as your modern day immigrant, we just packed our bags, my wife and I, our suitcases, and flew over just like that. There was no relocation package. There was nothing, right? We were just in Israel. Israel invented one of the most successful unknown managerial systems. In free translation, it's called "It Will Be Okay." That's a very known thing in Israel. I'm translating. So that was my MO. It will be okay. 20 years later, it is okay so far, I think. So that was what drove us over, so to speak. I did start investing in US real estate, very like one rental property and another two little investments in a group investments before coming over. So I made 1.5 investments, so to speak. I don't know even how to quantize it. Something not very exciting, but for me, it's super exciting. But looking back, nothing too exciting as an investment wise. But that got me excited about US real estate investing, right? So that got me started. And as soon as I started investing, very early on, I knew that this is something not only that I like and I want to do, I felt that I need to immerse myself, surround myself, to be a professional, to know what I'm doing. I need to really dive in, all in. This is not even, it's funny, I'm using those terms, thinking now, I wasn't jumping to the deep water. I was jumping straight to the deep water of the ocean in a way, because I was buying a property from Israel in the United States, 2002, no Zillow, no public records, all that stuff, all done remotely. Yes, I had some English with me, basic English at the time. My English was not very good, but it was just okay. That helped. Maybe spoke a little bit American, not even 2 years. I don't think you even learn. I really distinguish between English and American.
There is a distinction between English from the UK and English from the United States. That's for sure.
Yeah. And that was what got me excited. And I decided I want to, and in a way that got me encouraged to make the move and jump over the ocean and come over.
Yeah. So you didn't even just jump into the deep end of the pool. You got on a boat, went out into the middle of the ocean and dove right in. Who cares about the sharks, right? You can go past them or punch them out.
When you're young, special forces, you don't care about sharks.
There you go. There you go. All right. So there was something else you were talking about in your background, right? When you came over here, you saw what other people were doing, right? And it was one of those things that you said, I feel you're comparing yourself to the other people, saying that you were not on a good financial path. And that's the first thing that comes to my mind, is how it's a very popular saying too, is how comparison is the thief of joy. And I feel like when you compared yourself to those other people and you were pulling that joy away from yourself, you said, how do I get this joy back? Right. And that's when you started that search to figure out how to build passive income and things like that. So what was it that turned you towards real estate? I know you started before you came over here, that you said you had like 1.5 investments, right? But what was that trigger for you where you said, this is what I want to do to build my legacy?
Earlier, when I said that I knew that I was looking for the path to do well financially in life, knowing I had some realization at a young age. I knew that hard work is not going to get me there just by hard work. And then the second thing is, I did not know how to get rich quick. That was all obviously a fantasy in my mind, but I just didn't know how to execute it. So I just started saying, if I don't know how to get rich quick, I need to start looking for another mechanism that will help me get rich slow. And then I also realized, after investing for maybe a year or two in stocks and options, that I wasn't happy with the returns relatively to the risk I was getting from stocks and options.
Okay, so you started off in the stock market.
Yeah, I think many of us, the first thing we do is this is like what everybody's doing, right? So I just started
Same here. Same here.
Yeah, because first of all, the threshold to the barrier to entry is kind of low because you don't need a lot of money to buy one stock, right? Actually, you need very little, so to speak. And so that seems like the right avenue to start. But I was like, okay, what is going on here? I'm taking relatively high risk and getting okay rewards, not reflecting the risk I'm taking. And I didn't like that. I didn't like that that formula was not working well with me. So I knew that also, I think that I started realizing that watching the stock ticker and reacting emotionally, I knew this is not a healthy thing for me. I wanted to find a way to shelter myself from emotional decisions, quick decisions. And the real estate was in a way an answer, or a way to answer to address that. So the real estate for me was, first of all, you can react emotionally, it doesn't matter, because you don't normally buy on a Monday, say on a Tuesday, a piece of real estate. Yes, you can do it in certain ways, but normally that's not typical with real estate. So I knew that's a good thing for me. And the second thing I realized is that to this day, when I do some mental exercise and think about different investment opportunities altogether, not just real estate, I always try to evaluate what would be high rewards, lower risk. And there's still to date, I found one avenue that offer high rewards, lower risk, and that's long-term rentals, right? Long-term rentals, I think many types of real estate may, but especially residential long-term rental kind of helps with that formula of high rewards, lower risk. And I like that because that was the opposite from stocks. It was the opposite of investing in other more risky adventures, right? So for me, it fit very well the fact with the rewards, the risk, and the fact that I'm not going to be able to make fast emotional decisions. So it was kind of, in a way, it was shielding me more than anything else.
It forced you to slow down.
It forced me to slow down. Perfect.
Yeah. It can be pretty detrimental if you're a new investor and you're on Robinhood or some other app where you can buy and trade stocks almost instantaneously, right? That can cause issues if you don't know what you're doing. I don't recommend day trading because it is very volatile if you do it. There's a lot of people that do it, and some people are successful and some people lose their shirts.
Yep.
But at the same time, you were like, hey, if I do this real estate piece, I can't just buy it and then sell it the next day, or I can't just hurry up and try to turn a quick profit. Maybe you could if you were flipping a property or wholesaling. Sometimes you can do things like that, but you were looking more for the long term.
Correct.
Right? What am I going to do to keep to get an asset that's going to keep paying me? So your focus was on building long-term wealth, which I feel like a lot of people could benefit from hearing something like that, because it's not about getting rich quick. It's about building your wealth over time.
Exactly.
And when you do that, when you do, that's how you find these successful people that everyone thinks are overnight sensations. But what in reality, what happened, it was years of work that they put in.
Yeah.
Let's talk about that a little bit. You got over here, you got into real estate. What was your first deal? Like, what did that look like for you when you said, this is what I want to do?
The first, I think this has been a while. The first deal that I did when I came over, I think I bought just another rental property in south of Fort Worth, Texas. Brand new property from the builder, probably 142,000-ish. It's funny, I don't have that property anymore for years, more than 10 years, but it will be interesting to Prospect Hill Drive, 2606 probably.
Oh, see? You remember the address.
Now I'm curious to see how much it's worth. It's probably worth in the 300s by now. That'll be
what year was this that you purchased it?
2004, I believe.
Okay.
Probably. Yeah, okay. 2004.
As real estate was on its boom, right?
Yeah.
Early
just
2000s.
Just kind of getting to it. That little house I bought in Phoenix, probably around 2005, I refinanced it for the second time, I want to say. And that little house purchased 4 more properties for me.
Wow.
Just by refinancing, pulling cash out. Yeah. Then I bought another one. I bought a bunch. I don't even remember all of them at the moment, but I remember I bought another one in East Orlando with a tenant inside. The tenant has been there for a long time. And it's funny, that property in East Orlando, again, it's a middle class, I would even say maybe lower middle class community, small HOA, 1,400 square foot, 4-2 with 1-car garage on a corner lot. Nothing fancy. I mean, nothing, just a nice single family home, nothing exciting. That house is probably, I bought it for 190,
Okay.
180 or 190. That house is worth 350 now. It had over the years 3 tenants. So we're talking about 2005 to 17 years, 3 tenants.
That's pretty good retention right there.
Unbelievable.
Yeah.
Not all my stories are like that, but that's definitely one of them. It's, again, you would think that I perfected all the decisions. No, I just bought it. I knew one thing. It's a good area. It's a good area. I had no idea it will hold tenants for such a long time. I don't think ever any of my current tenants, really sweet people, a couple, they were having some issues just towards the end of COVID, right? She lost her job. He lost her job. So I was actually carrying everything for about 3 months, and then they got a job, started paying. So that was the most difficult thing with this house, was those 3 months towards the end of COVID that they had went through a rough patch. And I said, listen, you guys, I know you've been great tenants, never always take care of the property. Let's just hang in there for a month or 2 or 3 and reevaluate. And since then they already paid, and the rent was increased, and then they made up every dollar they missed. They made up over time. It's really a really good in many ways.
Yeah. All right, Dani. So listen, this is what I want to do now. I want to gear this conversation towards the current economy and what it's looking like right now. Okay. So there's a lot of uncertainty right now in the real estate market. Now, the reason why I asked you when you started investing over here, right, that it was 2004, 2005 timeframe you were buying properties. Obviously, 2008, 2009 happened, right? So you went through that. You went through a down market, and it looks like you survived it. So what was your experience when that happened, when 2008, 2009 hit, and we had that crash in the real estate market? How did you overcome that?
Okay, that's an excellent question. So first of all, Mike, you only see my head. You don't see my arms, my heart. You don't see all the scars that I have from those years. And I do have not physical scars, but financial scars, wallet scars, emotional scars. So I was in the middle of that storm with many properties, with a lot of my clients. So this is not something that flew by me. I was like in the eye of the storm for sure. So when the storm started dying, actually, let's put it this way. One of the things that I think I'm lucky with, I was able to understand early on what was going on. So early on, I could see things are going, like very early on. And I'm saying we're using early on because I've seen people around me that were fighting tooth and nails to kind of weather the storm. And what the decisions I made early on, such as letting some properties go, foreclosure, actually helped me rescue others. And I've seen other people not doing it a year later, maybe a year and a half later, losing more money because of it, only to come to the same realization much later. So that's actually hurt them even more. Why did I have this early epiphany or understanding at a 30-year-old beginner investor? I have no idea till this day. Just a good common sense, a good grasp of reality. I don't know, but that's how I operated. And that actually turned out to be smart eventually. Also, when you think about people talk about foreclosures, I think a lot of people know that when you run through a foreclosure, it takes 7 years until the banks wants to give you a loan again. It's not necessarily true. Banks were willing to work with me much less than 7 years. But to really clear your credit report with the crappy stuff from the foreclosure for those crisis years, it takes time, right? So the sooner you start, the sooner those items will be out of your report, right? Sooner. It takes a long time, but so that's something that I only realized many years later. Another smart thing that happened in that case. And I did let some property goes for foreclosure, not all of them. I hang on to the others. I fought on some of them with even legal actions. Personally, my income which was real estate dependent, dropped dramatically. So my biggest struggle was to stay afloat. And I had to make a lot of changes in-house with me and my wife just to get by. So those were not tough, easy years. But as soon as I saw things are dying out in the crisis mode, then I came back to circle back and I said, okay, I need to start things fresh from the beginning. All right, let me reevaluate everything in my life, financially, everything in my business. And in many ways, my business today is sitting on the ruins or the devastation that happened through the crisis of 2008. So a lot of the decisions to this day, we're talking about 14, 15 years later, are still coming back to the root of the decision, the core of the decision were what happened in the crash of 2008. Even today, we were looking at properties in a new geography, and I'm like, I don't know, this geography doesn't seem resilient enough for me. Why would I say something like that? All comes back to 2008, 2009.
You got PTSD from that event.
Yeah, exactly.
So, yeah, I asked because I got out of the real estate game after 2008, 2009 because I had to short sell a property and it financially put me in a very bad place. And it took a long time to recover from that. And
hello, club member.
What's that?
Hello, club member.
Yeah. But so I stayed out of the real estate game for a long time until 2019 when I started getting back into it. So that's why I wanted to ask you about that, because a lot of people right now are like, hey, okay, we're seeing some trends that feel very familiar, high debt and lower income, people losing their jobs. It's looking rough out there. The economy is not doing so hot. We've seen the stock market tank a couple times. We saw crypto rise and fall, right? So with all things being said, real estate was still going pretty steady. Now we're starting to see some of these prices drop, right? But nothing significant, right? Not like 2008, 2009. I'm curious, do you think that's coming? Or do you think we're just slowly bringing it down and managing it better because of our past experiences?
Okay. So here's my personal opinion, super biased opinion. I love real estate. 20 years in real estate, I've never stopped buying, right? So no matter what the economy was doing, maybe there was a period of reevaluating, reassessing, but few months, right? So just keep that in mind to be completely open and honest about how I operate. But I think there's a lot of mixed signals, a lot of mixed messages out there. You read that companies are letting and firing employees, and then when you actually read behind the title, that the numbers are not that big. So even Walmart announced they're letting 2,300 employees go. 2,300 out of a 1.3 million people. That's nothing. That's more than, that's what they normally let go. Just people, that's probably what people just leave their job in Walmart on a weekly or monthly basis easily, or even less. So 23 is such a small number, right? Yeah. To a 1.3. So that's mixed signals, right? And you hear something like that in multiple companies around the country, which I think we're going, first of all, through a correction phase. I don't know if a crash, we went up like we were accelerating so fast. Now we are slowing down. Makes super sense in the economy. That's obvious. Then a lot of people, at least the ones that I come and talk to us, they think that they can go out there and, real estate is slowing down. Prices are dropping. This is a buying opportunity. I should be a buyer. Those who understand it, which like myself, yes, but let me surprise you a little bit. We are still competing on houses, multiple offers, not multiple offers like a year ago of 10 offers or 20 offers, 3 offers, 4 offers on good houses. And then when we run searches on different areas that we invest in, and we look at the properties that we like to buy, after we filter things out, the inventory is so small, no wonder it's going to be multiple offers. It's a very strange market, real estate-wise, out there. First of all, let's keep in mind, every metro is different, right? Austin is maybe going through a rougher correction because it also went up like crazy. Then, I don't know, then Nashville or maybe Tampa, right, for that matter, or Hawaii. So every market
it's very market specific.
Yeah, exactly. So some markets are declining faster. Some markets are declining very slowly. Inventory, demand, supply and demand dropped a lot on both ends of it. So that means that, but still there's more demand or much higher demand than supply out there. I'm having in just the past few days conversation with different teams and different realtors I work with, and they're saying, what are you talking about? There's such a high demand for housing. We can't keep up with the demand. We only think that in our market, and this is something, a repeat conversation in multiple areas, prices will start going up again because it's crazy. Supply and demand is the basic force here, and that dictates a lot of what the market will do. And that's where we are in terms of real estate. We think it's nobody's market. So it's not really a buyer. It's not really a seller. But we are seeing, like, when we are out there making offers, it's challenging. It's challenging to find and it's challenging to buy. And we have to spend a lot of time being creative to make it work. So if someone is listening saying, oh, market is slowing down, it's an opportunity for me to buy. It is, but it's not a great opportunity as you may think, because out there, there's still low inventory and you will be fighting. And again, if you're in, I don't know, in Bozeman, Montana, you may be in a different situation than if you're buying in Orlando, Florida. Completely different situation, inventory-wise and in demand-wise. So it's tricky. It's very interesting. It's a nobody's market at the moment, and it could very soon turn into, again, seller's market. Because if you really think about it, the correction or the slowing down started July of 2022. So that's about 9 months ago or so. And we're not crashing. We're just still slowing down. We're not crashing. So people are like, okay, the crash is coming. The crash is coming. Wait, we've been waiting for 9 months. What's going on? They promised me a crash. So it's weird where we are with the market. And it's strange how things are now. Maybe spring is coming. So we'll see. Yeah. More houses will come on the market.
Attention, fellow real estate investors. I know you're tired of ineffective marketing strategies that leave your lead generation feeling like a bust. Well, I've got a great solution for you. I've teamed up with Ballpoint Marketing to bring you a fresh approach to growing your business. With their handwritten direct mail marketing, your business will stand out from the crowd. Their amazing writing machines will craft personalized messages for each of your potential clients, making a lasting impression and increasing the likelihood of them responding to your message. They even make pen smudge marks to add to the authenticity. And for those of you that are driving for dollars, one of their most popular offers are handwritten door hangers. Placed directly on the front door, these door hangers show a potential seller how serious you are. With Ballpoint Marketing, you can trust their marketing strategy will be both effective and unique, just like your real estate business. Use my coupon code AVGJOE for an exclusive discount. Don't miss out on this opportunity to grow your real estate business and generate leads. Click the link in my bio for more.
What's going on, everybody? So today I want to talk to you about the podcast editing service that we use for the Average Joe Finances podcast. That is editpods.com. And what I really like about them is it's a subscription-based service, so the prices are fantastic. And not only do they do the podcast episodes for us, but they also make us videos, audiograms, social media caption videos. They do our show notes, thumbnails. It's just fantastic products. Go check them out at editpods.com. Let's get back to today's episode.
I've been saying it too. Like, I didn't really think that we were going to have a crash like 2008, 2009. A correction, yes. And we're seeing that, but it's a longer term like correction versus a rapid decline. And I'm also an active real estate agent out here in Hawaii. And what I've told my clients is, in our specific market, we saw this spike in prices during the pandemic, and just like everywhere else did, but Hawaii's pretty unique. Prices don't drop here that often. So we kept going up and up and up, and then we got to a spot where it dropped, and then guess what happened? It dropped a little bit, and it plateaued.
Yes.
And I was telling everybody, I said, look, it's plateauing right now. We're flatlined. This is the time, because it's going to start going back up. What happened? Guess what? 2 months later, it's back up to where it was before. And then it's continuing to go up right now as I speak. It's, again, market specific. So you have to know the specific market that you are investing in, right? So I think that's a great point, and I'm really glad you brought that up. Now, let's say real estate investors now, they're like, hey, okay, I know what market I want to get into. I studied it. This is where I want to be at. What would you say to them to mitigate risk in this environment that we're in right now with this slow correction that's happening around us? And also to mitigate, because again, none of us have crystal balls. Also, how do you mitigate it if there is that sudden drop?
Of course. So the way we are trying to go about it is to really, when we make offers and on how, like, if we value as an investor, right? Investor, not a homeowner. I'm looking at the numbers. Now, I know with the high interest rate, the numbers are going to be tough on the cash flow, right? So what I used to have maybe $2,500 realistic a year after everything in cash flow, I'm now maybe $1,500, right? Which is still okay, but it's not where we are. So the cash flow is tough. So the first thing I'm telling my clients is, listen, look at the property as is based on how we analyze it today with today's current rate. And then once you've got everything, in order and you're maybe just okay with it, take a step back, change the interest rate from 7% or 6.5% to 5 or 5.5%. Let's just evaluate for a second in a normal interest rate environment. And now, when are we going to be there? I don't know, but my experience of being in real estate for 20 years tells me that there's very likely somewhere in the next year or maybe 2 to 4 years, we will go down again, not down to 3% and 3.5%, 5%, 5.5%. And now look at a property at 5.5%, right? I'm making an educated guess. How are the numbers now? Oh, the numbers now look great. Okay, so let's assume in the next 3, 4, 5 years, it's going to be tough on cash flow, and then you'll have an opportunity to refinance and get better cash flow. But along the same time, let's try and remember one thing. You're buying now, the sooner you buy, the better, and there's a good chance properties will start climbing back up, even slowly. I'm not talking about what happened in the craziness, right? Just slowly resuming going up. And the second thing is, let's see if we can try to mitigate the cash flow with a little bit of equity. It's tough because there's not a lot of inventory. But can we find a house that maybe we can buy for $10,000, $15,000, maybe even $20,000 below? Remember, I'm talking about the $200,000, $300,000 home. How about some 10% below market, right? Which is not a lot. But the reason I want to buy just a little bit below market, I want to buy a lot below market, but it's not unrealistic. So maybe like $15,000 below asking or market value. It's for two reasons. First of all, it helps with the cash flow. Second, psychologically, it tells me, okay, I have a little bit of buffer. If the market crashes, we still have the mindset. I am mitigating on that. And it's a way for me to mitigate or to compensate for the lack of that cash flow. So that little buffer, little gap, if I'm able to get that, and we are, not always, but we are, helps with that mindset. So a lot of it is psychologically thinking about those things, evaluating them. It's very difficult for me, I think, from what I'm seeing, for investors to kind of divide and conquer all those little boxes, right? But once you tell them, do 1, do 2, do 3, do 4, and even if we get 3 out of the 4, that's pretty good. If we get 4 out of 4, amazing. 3 out of 4, it's pretty good. And that's how people are like, okay, now I get it. I see, I understand. And then I also tell them, be patient, right? There's no rush. It may take us 3 months to buy, maybe a month, maybe more. If you be patient and you don't pressure us while you're not seeing anything, it's because it's a tough market, and we will help you find the right property for you.
Yeah, all real estate investors need to have that buy box, right? What is the criteria for you that works for you that will make this deal work? If it does not fit in the buy box, then you walk away from that, right? And that's one of the things too, like somebody might think, oh, I got this really good deal. If it was just maybe a little bit less, or if I just had a little bit lower interest rate or whatever, like then this would work. It would cash flow and this and that. And sometimes they'll find themselves tweaking things a bit to make it work. And that's when you get yourself into trouble. So don't set that criteria for yourself and hold yourself true to it. That's one of the ways you're going to help mitigate that risk. And the other thing you were talking about too was having that equity piece, right? If you're able to get it at a 10% discount, which is fantastic, right? 10, 15%, that's wonderful. If you can do that, you're giving yourself that buffer for these dips that are happening, right? Because there's smaller dips. But again, too, that is also market specific, right? Because there are markets that will appreciate very well and maybe not cash flow that great. There are markets that will cash flow fantastic, but they won't appreciate and value that great.
True.
So
true.
You have to figure out what it is you're looking for, figure out what your buy box is, and stick to that and be consistent with yourself and your actions. Yeah, absolutely. Okay, so what are some of these like important factors that you believe people should be looking at with the market changing so much? We know it's market specific, but what should somebody look at if they're going into a deal like the baseline?
You just said it yourself a minute ago, and this is something, the same terminology I'm using is the buy box and the criteria. And I think a lot of investors, what they're doing is they like, it's crazy. Why aren't you taking 5 minutes when you start this journey? You know what? Maybe you went to and attended 20 different real estate meetings online or in person. That's great. At some point, stop. Sit down, decide on your strategy. It doesn't have to be long-term rentals, whatever, short-term rentals, flipping house, whatever. and put your buy box together, sit down and create that baseline criteria, which you mentioned. I'm using it all the time. And I'm like, it's only going to take you 5 to 10 minutes with your coffee in the morning or wine at night to write those criteria. And those criteria for me, it's like the simple question I ask you, what is a qualifying property for you? Not for me, not for Mike, for you. Size, age, location, I don't know, price, mortgage. Maybe 7 criteria, maybe 10 criteria. And that should tell you not what's the ideal, not what the perfect. What is if you see this one, you say this is something I should consider buying or at least pursue more research. Most people, they sign up for databases, they go and look at photos. Why? Take a minute with yourself, set that up. And then when you see looking at properties, you have to see if they're matching what your criteria is. And should tell you, I should focus on this one or not. I should move forward to something else or not. And that will help you be more focused on the relevant properties for you and not waste time over just some email that's irrelevant. There's always another great deal around the corner. Always, right? Don't worry about it. Forget about it.
Spot on, Danny, because the thing is, if it meets that basic criteria of your buy box, now you're like, okay, this meets the basic criteria. Now you really sit down and take a look at it and say, okay, this is the offer I could put in that makes sense. This is the number that makes sense. And, it might be a lot lower than you thought you were going to offer. And the seller might even feel disrespected by it. But at the same time, it has to meet your criteria. Submit the offer. Worst thing they could say is no. Right?
Exactly.
And even if it's completely off the walls to you, you think, oh, I'm asking for 40 grand off of this $210,000 property. There's no way they're going to say yes to that. Yeah. Who knows? Maybe they're in distress and they just need to get this property off their hands, or maybe a relative passed away and they have this property sitting here. They just want to get rid of it and offload it. You never know what somebody might say yes to.
You never know. Yeah.
So I think that's huge. So thank you so much for pointing some of that stuff out, Danny. Now, this conversation's been super valuable, especially when we're talking about how the market has been shifting and we're seeing this correction happening live as we talk, right? Now, this episode will be out in about 3 months, right? So hopefully we've seen some changes, but if not, so everybody knows, this is April when we're talking about this.
Mid-April,
giant spike in the market. We didn't know about it. And my crystal ball doesn't tell me anything. It's just cloudy.
Broken.
It's broken. But yeah, so this has been great. I've gotten a lot of value out of this. I'm sure my audience has too. So what I'd like to do now is transition this into something I call the final round. Okay. I'm going to ask you the same 4 questions I ask everybody that comes on the show, and it gives us a good idea of how you are when you get asked pretty tough questions. You ready to go?
Okay. Yeah.
All right, Danny. Now, you've been investing in real estate for a while. So I'm sure throughout that time frame, there's plenty of things that you look back and be like, man, I wish I could have done something a little bit different about A, B, C, or D. So what would you say is the biggest mistake you've ever made in real estate?
I think that one of my biggest mistakes was over leveraging, buying as many properties as I can. And looking back, you know what? I wish I just bought half the number of properties, less leverage. I like to look at it as I want every property to be an independent of me, meaning if I lose my job and I cannot work, I don't need to feed the alligator, as they call it. So I want every property to be independent of me. And I have, by design, early on in my career, highly leveraged, negative cash flow. I wanted to buy as many properties as I wanted, and that turned out to be not a good thing. I wish I've not done that.
Yeah, absolutely. Thank you for that. Thank you for your transparency. Appreciate that. That's just the way it goes with a lot of us, right? You get that time that you make what you think is a small mistake, and it snowballs into something else. So over leveraging yourself that could put you in a really bad spot, especially if you did it around 2008. Hey, so I appreciate that. Now, the next question, Danny, ties into that one. These all kind of tie into each other. And that is, what is something that you've learned that you wish you knew when you first started out?
Again, lesson learned from the crash of 2008 will come. It seems like it's a repetitive theme here for me. It's all my life is part of it. The way I started analyzing and evaluating properties in a very comprehensive way after the crash of 2000. When I look at how I made decisions before the crash and after, this is not even amateur back then. And what a comprehensive way today with the Excel and how we look at properties, how we make decisions, how many decisions are going into each and every property, and knowing that maybe some of them will fail, And then if we have multiple important decisions in the decision process, and let's say out of 25 important decisions, even 5 fail, there's still 20 smart decisions that are holding everything. And when I say something fails, it doesn't mean that 5 decisions completely failed. It just means I thought it would be X and it's only half X. So it's still half successful decision, half failing, but there's still 20 other decisions along the way that support that decision on that property. I'm using very abstract, but the whole idea is like there's not a single or 2 or 3-legged decisions on every single investment property that we make. It's like many legs, allowing not all of them to, obviously we don't know what will happen. So allowing some of those legs to not live up to their promise, so to speak, and we're still okay. And that's really important.
Yeah, sounds like you want to be like a centipede or a millipede, right? You have all these legs that carry the body across to where it's trying to go from point A to point B. I like that. All right, Dani, next question is, do you have any tips or tricks that you would recommend to someone that is just getting started out today?
Yeah, the first thing I would say is, we already mentioned about setting up your criteria. The second thing I want to mention is like what not to do, right? So there's a lot of things that I think people are doing and they're not realizing they're doing it. And that's, for me, a shame. Don't listen to conventional stupidity. And when conventional stupidity, there's a lot of knowledge out there that people are copy pasting without knowing. For example, someone comes to you and say, you only use the 1% rule. No. Maybe not. So no, the 1% rule, it's not always correct. Actually, many times it's incorrect. So I call it conventional stupidity. Another example would be always buy with an SC. No, some instances are requiring or good for an SC and some are not necessary. So it's not a yes or a no. Okay, so those things that people are just repeating and they're not thinking for themselves. The way I like to suggest for people a tool how to evaluate a suggestion and advice, ask the person who's giving you the advice, what's their experience? When someone tells you only use the 1% rule and they've never invested in their life because they heard it in multiple events, you got to question that advice, right? But if someone is telling you always use the 1% rule, I've done thousands of deals and this always works still until yesterday, I will value that advice a whole differently, right? So ask that person, oh, how long have you been investing? How many properties you have? Because a lot of people have been investing for years and they haven't had a single property. They're just dancing in the niche of investing, right? So value the advice based on the person who's providing and their true experience. And don't just take blank answers or conventional stupidity.
Awesome. I always like using metaphors. So it's don't listen to the parrots. Listen to the person that gave them that phrase to say. Exactly. So the person that has that experience, that has done it through the school of hard knocks.
Exactly. I love it. Perfect.
Yeah. No, that's fantastic. Okay. The final question, Dani, is an opinion-based question. And it's, do you have a favorite business, investing, or real estate related book or podcast or both?
Podcast. I've started listening to you as getting ready for our meeting, and I'm really enjoying a lot of content. And you know what I love about your podcast? It's not just real estate. It's business advice. It's marketing. So that, for me, I go through a lot of podcasts. That's my thing personally as a listener. And there's a lot of, am I allowed to say crap out there? A lot of noise, which is hard to filter. So, for example, I don't want to name names, but I want to not dimension one. There is a big real estate forum out there. Everybody knows what the biggest one of them all. A lot of the podcasts they're using a lot of conventional stupidity. There's a lot of blank statements, right? If you're listening to that, you are not going to be successful, in my opinion. You got to go to the niches. Don't listen to real estate investing. Listen to the niche, the one who's doing rentals, the one who's doing Airbnbs, the one who's doing self-storage. Find those niches and then listen to one of those. If you want to get really knowledgeable on that niche, and find the one who will provide quality like yours, the Average Joe podcast, which is covering a lot of bases. So that's, for me, more important than just a specific one. There's one specific as you get that I don't really like.
Yeah, I appreciate your kind words there. And yeah, it's important to listen to the stuff that you can relate to, right? The things that are going to help you take action, right? Because you could sit here and listen to podcasts all day and watch YouTube videos, read books, but if you don't take action and do something about it or do something with this knowledge and information that you obtain, then you're just failing yourself. And then
Keep on
all that
doing what
stuff that
you've
you're
been
doing right
doing.
now that you think is helping is meaningless.
Yeah. Yep. Exactly.
So,
I love it.
I
So
definitely
true.
appreciate that.
Yeah.
Okay. So, Dani, that is it for the final round. However, I have one more question for you, and it's the most important question of this podcast because we talked about a lot of great things. You've added a lot of value to our audience here. It's not every day that you talk about the corrections that are happening in the real estate market and different strategies to mitigate some of those risks associated in a fluctuating market like we have right now. For one, I want to say thank you for all the value that you added to me and my audience today. I genuinely really appreciate that. Now, this question, like I said, is the most important one because people that have listened to this are going to say, hey, we want to know more about Dani. We want to know more about what he does. And I understand you help other investors. And so I want to get that information out there for everybody to check you out. So where can people find you? Do you have a website, social media, anything like that you could share with us today?
Yeah. Online, we are easily found under our web identity, my alter ego. It's called Simply Do It. So anywhere you'll put Simply Do It Real Estate or Simply Do It Dani, you'll probably land in one of our pages, online pages, social media, or another. The website is easy, simplydoit.net. So if you want an easy way to find us, just look for Simply Do It. And hopefully you'll find the right page. That should be working very nicely. There's a lot of content that we put out there as well. Teaching, educating. I always like to participate in, and thank you for that, Mike, for that opportunity, because I think I always believe that sharing and letting people know that helps others, they'll succeed. They may come and want to work with us or not. It doesn't matter. It's just about succeeding and doing, like you said, taking action. Very important.
Yeah, absolutely. Thank you so much for that. I'm going to make sure that I have all those links in the show notes to make it easy for everybody so they don't even have to do the Google search. They can just copy and paste or click away, and you can find out more about Dani and his site and what he does to help educate other investors in these crazy times that we're in right now. Again, Dani, thank you again so much for taking your time out of your day to provide so much value to me and my audience. I really appreciate it.
Thank you very much. Pleasure. Thank you for having me.
Absolutely. And hey, I also want to thank all of my listeners for joining me and our special guest, Dani Beit-Or, on the Average Joe Finances podcast. Make sure you go leave us a 5-star review and tell us what you liked about today's specific episode with Dani. Aloha from Hawaii, and have a great rest of your day.
Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.
Thanks for listening to the Average Joe Finances Podcast, your source for beating debt, saving money, and investing. Learn more at averagejoefinances.com.